Question 1. Which of the following statements is true regarding the difference between the primary market and the secondary market? A. The primary market is where outstanding securities are traded between investors, while the secondary market is where new issues are sold by issuers to investors. B. The primary market facilitates the initial sale of securities by an issuer to investors, while the secondary market is where these securities are subsequently traded among investors. C. Both the primary and secondary markets are regulated exclusively by FINRA, overseeing all trades. D. Securities transactions in the primary market are always subject to higher commissions than in the secondary market. Answer: B. The primary market facilitates the initial sale of securities by an issuer to investors, while the secondary market is where these securities are subsequently traded among investors. The primary market is where new issues of securities are first sold to the public by the issuing corporation or government. This is typically done through an initial public offering, IPO, or a subsequent primary offering. Conversely, the secondary market is where these previously issued securities are traded among investors, such as on exchanges like the NYSE or Nasdaq, providing liquidity. Understanding this distinction is fundamental to grasping how capital markets function and the roles of various participants. Question 2. A registered representative opens a new discretionary account for a client. Which of the following is required before the first discretionary trade can be executed? A. Verbal consent from the client for each individual trade. B. A written power of attorney from the client. C. Approval from a principal of the firm. D. Both a written power of attorney from the client and approval from a principal of the firm. Answer: D. Both a written power of attorney from the client and approval from a principal of the firm. To open a discretionary account, a registered representative must obtain written authorization from the client, typically in the form of a limited power of attorney, granting the representative the authority to make investment decisions without prior client approval for each trade. Additionally, FINRA rules require that a principal of the firm must review and approve the discretionary account agreement and frequently review discretionary trades to ensure suitability. Both steps are crucial safeguards against potential abuse and ensure compliance with regulatory standards. Question 3. An investor owns one ABC Jan 50 call option. If ABC stock is currently trading at $55, what is the intrinsic value of this option? A. $50. B. $500. C. $5. D. $5,000. Answer: B. $500. A call option gives the holder the right to buy the underlying stock at the strike price. This ABC Jan 50 call option has a strike price of $50. With the stock trading at $55, the option is in the money by $5 per share, $55, $50. Since one option contract typically represents 100 shares, the intrinsic value for the contract is $5 per share multiplied by 100 shares, which equals $500. It's important to remember that options values are quoted per share, but the contract value covers 100 shares. Question 4. Which of the following municipal bond features makes it particularly attractive to high net worth individuals? A. Taxable interest income at the federal level. B. Exemption of interest income from federal income tax. C. Guaranteed protection against inflation. D. Higher yields compared to corporate bonds of similar credit quality. Answer: B. Exemption of interest income from federal income tax. The primary attractive feature of municipal bonds, especially for high net worth individuals, is the exemption of their interest income from federal income tax. Additionally, if the bondholder resides in the state or municipality where the bond was issued, the interest may also be exempt from state and local income taxes, making it triple tax exempt. While their yields might be lower than corporate bonds due to this tax advantage, the after-tax return often proves more beneficial for investors in higher tax brackets. This tax treatment is a key differentiator in fixed income investing. Question 5. Which of the following best describes the role of a transfer agent? A. Facilitates the trading of securities between buyers and sellers on an exchange. B. Maintains records of stock and bond owners, issues and cancels certificates, and handles dividend and interest payments. C. Provides investment banking services, such as underwriting new securities offerings. D. Offers investment advice to clients and executes trades on their behalf. Answer: B. Maintains records of stock and bond owners, issues and cancels certificates, and handles dividend and interest payments. A transfer agent is a critical party in the securities industry, primarily responsible for keeping records of who owns a company's stocks and bonds. They issue and cancel certificates to reflect changes in ownership, and manage the distribution of dividends, interest payments, and proxy materials to shareholders. Their role ensures accurate record-keeping and efficient communication between the issuer and its security holders, distinct from the roles of brokers, exchanges, or investment bankers. They are the custodian of the official shareholder register. Question 6. Under FINRA rules, what is the maximum gift value a registered representative can give to a client annually without triggering specific reporting requirements or limitations? A. $50. B. $100. C. $250. D. $500. Answer: B. $100. FINRA Rule 3220, known as the Gifts Rule, generally prohibits a registered person or their firm from giving anything of value in excess of $100 per person per year to any employee of another member firm or any person where such gift relates to the business of the recipient's employer. While this rule primarily addresses gifts between associated persons of member firms, it is broadly interpreted by firms to apply to client gifts as well to avoid the appearance of undue influence or impropriety. Gifts exceeding this amount must typically be reported and may require firm approval. Question 7. A customer wants to invest in a security that offers potential capital appreciation and current income, with limited risk exposure. Which of the following would be least suitable? A. A growth stock with a low dividend yield. B. A balanced mutual fund. C. A covered call strategy on a blue-chip stock. D. A high-yield corporate bond. Answer: A. A growth stock with a low dividend yield. The client seeks capital appreciation and current income with limited risk. A growth stock with a low dividend yield primarily focuses on capital appreciation, but typically offers very little current income and can have significant price volatility, which increases risk exposure. A balanced mutual fund, a covered call strategy, and even high-yield bonds, despite higher risk than investment grade, generally offer a better balance of income and potential appreciation or risk management, making the pure growth stock the least suitable option given the client's stated preferences. It's crucial to match investment characteristics with client objectives. Question 8. Which of the following is not a characteristic of a limit order? A. It specifies a price at which to buy or sell. B. It guarantees execution at the specified price or better. C. It guarantees execution, regardless of the price. D. It may not be executed if the market price moves away from the limit price. Answer: C. It guarantees execution, regardless of the price. A limit order specifies a maximum price to buy or a minimum price to sell. This means it guarantees execution at the specified limit price or a better price, but it does not guarantee execution itself. If the market price never reaches or passes the specified limit price, the order will simply not be filled. In contrast, a market order guarantees execution, but not the price. Understanding the trade-offs between price certainty and execution certainty is key for order types. Question 9. An investor holds a bond with a coupon rate of 5% and a par value of $1,000. If market interest rates for similar bonds increase to 6%, what will likely happen to the bond's market price? A. The bond's market price will increase. B. The bond's market price will decrease. C. The bond's market price will remain unchanged. D. The bond's coupon rate will adjust to 6%. Answer, B. The bond's market price will decrease. There is an inverse relationship between interest rates and bond prices. When market interest rates rise, newly issued bonds offer higher coupon payments, making existing bonds with lower coupon rates less attractive. To compete, the market price of the existing 5% coupon bond must fall, causing its yield to maturity to increase closer to the prevailing 6% market rate. The bond's coupon rate itself is fixed and will not change. This concept is fundamental to understanding bond valuation and interest rate risk. Question 10. What is the primary purpose of the Securities Investor Protection Corporation, SIC? A. To protect customers against losses due to market fluctuations. B. To protect customers from losses due to broker-dealer insolvency. C. To regulate the activities of broker-dealers in the securities industry. D. To provide insurance for bank deposits. Answer, B. To protect customers from losses due to broker-dealer insolvency. SIPC's primary purpose is to protect customers' cash and securities up to $500,000, including a $250,000 limit for cash, in the event that a broker-dealer fails or goes bankrupt. It is not designed to protect against losses resulting from market declines or poor investment choices. SIPC protection is distinct from FDIC insurance, which covers bank deposits. This safety net helps maintain investor confidence in the securities markets by safeguarding their assets held by member firms. Question 11. Which of the following types of orders is typically used by an investor who wants to buy a stock but only if it reaches a specific lower price, to limit potential loss on a short sale, or to protect a profit on a long position? A. Market order. B. Limit order. C. Stop order. D. Market on close order. Answer, C. Stop order. A stop order, or stop-loss order, is designed to protect profits or limit losses. A buy-stop order is placed above the current market price and becomes a market order when the stock trades at or above the stop price. A sell-stop order is placed below the current market price and becomes a market order when the stock trades at or below the stop price. This makes it suitable for closing out short positions, buy stop, or protecting long positions, sell stop, or even initiating new positions at a specific trigger point. It guarantees execution once triggered, but not the execution price. Question 12. A client is interested in investing in a growth stock but is concerned about significant downside risk. Which option strategy would be most appropriate to limit the potential loss while still participating in some upside? A. Buying a naked call option. B. Selling a naked put option. C. Buying a protective put option. D. Selling a covered call option. Answer, C. Buying a protective put option. Buying a protective put option is an ideal strategy for an investor who owns a stock and wishes to limit their downside risk while retaining unlimited upside potential. This involves buying a put option on a stock they already own, which gives them the right to sell the stock at the put strike price if the market price falls. The cost of the put option is the maximum loss on the protection, making it an effective way to hedge against significant declines without selling the underlying stock. Naked option strategies involve unlimited risk and selling covered calls limits upside potential, making them unsuitable for this client's specific objective. Question 13. Which of the following is considered a red flag for potential money laundering activities? A. A customer makes frequent small cash deposits that are just below the reporting threshold. B. A customer deposits a large check from a known and reputable financial institution. C. A customer consistently makes investments in blue-chip stocks. D. A customer occasionally requests wire transfers to family members. Answer. A. A customer makes frequent small cash deposits that are just below the reporting threshold. Making frequent small cash deposits just below the currency transaction report, CTR, filing threshold, $10,000, is a classic example of structuring, a common money laundering technique designed to avoid detection. Financial institutions are required to report suspicious activities to FINRA, and structuring is a prime indicator. The other options describe normal, legitimate financial activities. Recognizing these red flags is crucial for broker-dealers in fulfilling their anti-money laundering (AML) obligations and reporting suspicious transactions. Question 14. What is the primary difference between a municipal general obligation (GO) bond and a municipal revenue bond? A. GO bonds are backed by the full faith and credit of the issuing municipality, while revenue bonds are backed by the revenues generated from a specific project. B. Revenue bonds require voter approval, while GO bonds do not. C. GO bonds are typically riskier than revenue bonds. D. Interest from GO bonds is taxable at the federal level, while interest from revenue bonds is tax-exempt. Answer. A. GO bonds are backed by the full faith and credit of the issuing municipality, while revenue bonds are backed by the revenues generated from a specific project. The key distinction between municipal GO bonds and revenue bonds lies in their source of repayment and backing. General obligation bonds are backed by the full faith and credit of the issuer, meaning they are repaid from general tax revenues, and often require voter approval. Revenue bonds, on the other hand, are repaid solely from the revenues generated by the specific project they finance, such as toll roads or utility systems, and do not typically require voter approval. GO bonds are generally considered safer due to broad tax backing, and both types typically offer federal tax-exempt interest. Question 15. A customer who purchased a stock for $50 per share wants to sell it if it drops to $45 but also wants to protect against missing out on a rally if it goes above $55. Which two orders should they place? A. A GTC sell limit at $55 and a GTC sell stop at $45. B. A GTC sell stop at $55 and a GTC sell limit at $45. C. A GTC buy stop at $45 and a GTC buy limit at $55. D. Two market orders, one at $45 and one at $55. Answer. A. A GTC sell limit at $55 and a GTC sell stop at $45. To sell if the stock drops to $45, the customer needs a sell stop order placed at $45. This order would be triggered if the stock hits or falls below $45, becoming a market order. To protect against missing a rally and sell if it goes above $55, they need a sell limit order at $55. This order would execute at $55 or higher. Both orders should be good till cancelled, GTC, if the customer wants them to remain active until they are executed or cancelled. Placing both orders concurrently creates a stop limit combination strategy. Question 16. Which of the following statements is true regarding a not held order? A. It allows the registered representative to choose the asset, action, or amount without client authorization. B. It requires a written power of attorney from the client. C. It gives the registered representative discretion over the time and/or price of execution. D. It is valid indefinitely until executed or cancelled by the client. Answer, C. It gives the registered representative discretion over the time and/or price of execution. A not held order grants the registered representative discretion over the time and/or price of execution for a specific trade, meaning the representative is not held to a specific price or time for execution. However, it does not grant discretion over the asset, action, buy, sell, or amount of the security, as that would require full discretionary authority with written client consent and principal approval. This type of order is typically effective for the day only, unless otherwise specified, and is a limited form of discretion. It is distinct from a fully discretionary account. Question 17. A client tells their registered representative that they are a speculator and want to take aggressive risks for high returns. Which investment would be generally inappropriate for this client? A. Leveraged exchange-traded funds, ETFs. B. Hedge funds with high minimum investments. C. Certificates of deposit, CDs. D. Options on volatile technology stocks. Answer, C. Certificates of deposit, CDs. A client who identifies as a speculator and desires aggressive risks for high returns is seeking investments with significant growth potential, often accompanied by higher volatility and risk. Certificates of deposit, CDs, are low-risk, low-return investments designed for capital preservation and are completely inconsistent with a speculative investor's objectives. Leveraged ETFs, hedge funds, and options on volatile stocks, while carrying substantial risk, align with the pursuit of aggressive returns. Suitability dictates recommending investments that match the client's risk tolerance and objectives. Question 18. What is the maximum potential gain for the buyer of a call option? A. Limited to the strike price. B. Limited to the premium paid. C. Unlimited. D. Limited to the difference between the strike price and the current market price. Answer, C. Unlimited. The buyer of a call option has the right to buy the underlying stock at the strike price. Since there is theoretically no upper limit to how high a stock price can rise, the potential profit for a call option buyer is unlimited. Their maximum loss, however, is limited to the premium paid for the option. This unlimited upside potential, coupled with limited downside risk, makes call options attractive for investors who are bullish on a stock but want to cap their initial investment. Question 19. Which of the following entities is primarily responsible for enforcing municipal securities regulations? A. FINRA, Financial Industry Regulatory Authority. B. MSRB, Municipal Securities Rulemaking Board. C. SEC, Securities and Exchange Commission. D. All of the above, depending on the specific rule and participant. Answer, D. All of the above, depending on the specific rule and participant. While the MSRB, Municipal Securities Rulemaking Board, is the self-regulatory organization, SRO, that writes the rules for municipal securities dealers and advisors, it does not enforce them. Enforcement responsibilities are divided. FINRA enforces MSRB rules for broker-dealers, the SEC enforces MSRB rules for broker-dealers and municipal advisors, and the appropriate bank regulators, e.g., OCC, Federal Reserve, enforce MSRB rules for bank dealers. Therefore, all of the listed entities play a role in enforcement, depending on the specific circumstances and regulated party. This layered regulatory structure is important for investor protection. Question 20. In a margin account, what is the meaning of maintenance margin? A. The initial percentage of the purchase price an investor must pay. B. The minimum equity an investor must maintain in their account after the initial purchase. C. The interest rate charged on the borrowed funds. D. The total value of securities held in the account. Answer, B. The minimum equity an investor must maintain in their account after the initial purchase. Maintenance margin refers to the minimum amount of equity that an investor must maintain in their margin account after the initial purchase. If the equity in the account falls below this maintenance margin requirement, typically 25% of the current market value of the securities, the investor will receive a margin call and must deposit additional funds or securities to bring the account back to the minimum level. This is distinct from the initial margin, which is the percentage required at the time of purchase. Understanding maintenance margin is crucial for managing risk in leveraged accounts. Question 21. An investor who sells a call option naked, without owning the underlying stock, faces which of the following risks? A. Limited potential loss. B. Unlimited potential loss. C. Limited potential gain. D. The risk of the stock price falling significantly. Answer, B. Unlimited potential loss. Selling a naked call option involves significant risk because the seller does not own the underlying stock. If the stock price rises significantly above the strike price, the seller is obligated to buy the stock in the open market at that higher price and then sell it to the call option buyer at the lower strike price. Since there is theoretically no limit to how high a stock price can rise, the potential loss for a naked call seller is unlimited. This strategy is considered highly speculative and is only suitable for sophisticated investors with high risk tolerance. Question 22. Which of the following events would require a customer to update their account information with a broker-dealer? A. A change in their mailing address. B. A change in their marital status. C. A significant change in their financial situation or investment objectives. D. All of the above. Answer, D. All of the above. Broker-dealers are required to keep customer account information current and accurate to ensure that recommendations remain suitable and to comply with regulatory obligations. Changes in mailing address, marital status, and especially significant changes in financial situation or investment objectives, such as a large inheritance or job loss, all directly impact the suitability of investment recommendations and require an update. Failing to update such information can lead to inappropriate recommendations and regulatory issues. It is the customer's responsibility to notify the firm of material changes. Question 23. In a rising interest rate environment, which of the following bond characteristics would lead to the greatest price depreciation? A. Short maturity and high coupon. B. Short maturity and low coupon. C. Long maturity and high coupon. D. Long maturity and low coupon. Answer, D. Long maturity and low coupon. When interest rates rise, bond prices fall, and certain bonds are more sensitive to these changes. Bonds with longer maturities and lower coupon rates experience the greatest price volatility and depreciation in a rising interest rate environment. This is because the investor is locked into a lower coupon for a longer period, making the existing bond less attractive compared to new, higher-yielding issues. Conversely, short maturity, high coupon bonds are less sensitive to interest rate fluctuations. This concept is vital for understanding interest rate risk in bond portfolios. Question 24. An investor purchases 100 shares of XYZ stock at $60 per share and simultaneously sells one XYZ October 65 call for a premium of $3. This strategy is known as A. Protective put. B. Naked call. C. Covered call. D. Long straddle. Answer, C. Covered call. This strategy is a covered call. The investor owns 100 shares of XYZ stock, the long position, and simultaneously sells, writes, a call option on those same 100 shares. By owning the underlying stock, the investor covers their obligation to deliver the shares if the call option is exercised, limiting their risk. This strategy generates income from the premium received, but it limits the upside potential of the stock if its price rises above the strike price. It is often used by investors seeking to generate income from their stock holdings. Question 25. What is the primary function of an introducing broker-dealer? A. To execute trades and clear all transactions for their clients. B. To hold customer funds and securities. C. To accept customer orders and introduce them to a clearing broker-dealer. D. To underwrite initial public offerings. Answer: C. To accept customer orders and introduce them to a clearing broker-dealer. An introducing broker-dealer accepts customer orders and handles the client-facing aspects of the business, but they do not typically hold customer funds or securities, nor do they clear their own trades. Instead, they introduce these accounts and execute orders through a separate clearing broker-dealer, which then handles the back-office functions like record-keeping, custody of assets, and settlement. This division of labor allows introducing firms to focus on client relationships while leveraging the infrastructure of a larger clearing firm. It's a common operational structure in the securities industry. Question 26. Which type of investment company issues a fixed number of shares that trade on exchanges or over the counter, often at a premium or discount to their net asset value, NAV? A. Open-end mutual fund. B. Unit Investment Trust, UIT. C. Closed-end fund. D. Exchange-traded fund, ETF. Answer: C. Closed-end fund. A closed-end fund issues a fixed number of shares in an initial public offering, and these shares then trade like regular stocks on a secondary market, exchanges or OTC. Unlike open-end mutual funds, which continuously issue and redeem shares at NAV, the market price of a closed-end fund's shares can fluctuate independently of its NAV, often trading at a premium or discount. ETFs are also traded on exchanges but have a unique creation/redemption mechanism that generally keeps their market price close to NAV. Understanding these structural differences is crucial for selecting appropriate investment vehicles. Question 27. A customer establishes a joint tenants with right of survivorship, STROs, account with their spouse. If one spouse dies, what happens to the assets in the account? A. The deceased's share of the assets passes to their estate, subject to probate. B. The surviving spouse automatically becomes the sole owner of all assets in the account. C. The account is frozen until a court determines the rightful heirs. D. The assets are liquidated, and the proceeds are divided equally between the surviving spouse and the deceased's estate. Answer: B. The surviving spouse automatically becomes the sole owner of all assets in the account. In a joint tenants with right of survivorship, STROs, account, ownership of the account's assets automatically passes to the surviving tenant, S, upon the death of one account holder. This avoids probate, meaning the assets are not distributed according to the deceased's will or state intestate laws. This feature makes STROs a popular choice for married couples and others who wish for a direct transfer of ownership upon death. It's distinct from tenants in common, where the deceased's share would pass to their estate. Understanding account registration types is crucial for estate planning. Question 28. What is the maximum amount of cash that can be transferred between broker-dealers for a customer's account without triggering a currency transaction report, CTR, filing? A. $5,000. B. $9,999. C. $10,000. D. Any cash transfer between broker-dealers must be reported. Answer: B. $9,999. A currency transaction report, CTR, must be filed by financial institutions, including broker-dealers, for any cash transactions, deposits, withdrawals, exchanges, or other payments or transfers, exceeding $10,000 in a single business day. Therefore, the maximum amount that can be transferred without triggering a CTR filing is $9,999. This rule is a key component of anti-money laundering (AML) regulations designed to detect and deter illicit financial activities. It is important to remember this threshold applies to cash, not checks or wire transfers. Question 29. An investor owns a debt security that provides a portion of its return based on the performance of an equity index, while guaranteeing principal repayment at maturity. This is an example of A. Convertible bond. B. Zero coupon bond. C. Exchange-traded note, ETN. D. Collateralized mortgage obligation, CMO. Answer, C. Exchange-traded note, ETN. This describes an exchange-traded note, ETN. ETNs are unsecured debt securities issued by financial institutions that have a maturity date and offer a return linked to the performance of a market index or other benchmark. A key feature is that they typically guarantee principal repayment at maturity, making them different from direct equity investments. Unlike ETFs, ETNs do not hold underlying assets but are promises from the issuer. Investors should be aware of the credit risk of the issuer, as ETNs are essentially corporate debt. Question 30. Which of the following is considered a taxable event for an investor holding a municipal bond? A. Receiving semi-annual interest payments from an in-state municipal bond. B. Receiving semi-annual interest payments from an out-of-state municipal bond. C. Selling a municipal bond at a profit, capital gain. D. Holding a municipal bond until maturity and receiving its par value. Answer, C. Selling a municipal bond at a profit, capital gain. While interest income from municipal bonds is typically exempt from federal income tax and sometimes state and local taxes, especially in state bonds, capital gains derived from selling a municipal bond at a profit are always taxable. This means if an investor buys a municipal bond at a discount and sells it for more than their cost basis, the profit is subject to capital gains tax. Receiving interest payments from any municipal bond itself is not a taxable event at the federal level, and receiving par value at maturity is simply the return of principal. It's crucial to distinguish between interest income taxability and capital gains taxability. Question 31. A customer is long 100 shares of ABC at $50 and wants to protect their unrealized gain. They place an order to sell 100 shares of ABC at $48 stop. If ABC trades at $47.90, what will happen? A. The order will be executed at $48. B. The order will not be executed. C. The order will be executed at the next available price, likely $47.90 or lower. D. The order will convert to a limit order at $48. Answer, C. The order will be executed at the next available price, likely $47.90 or lower. A sell stop order at $48 becomes a market order once the stock trades at or below the stop price. In this scenario, if ABC trades at $47.90, the stop price of $48 has been triggered. Once triggered, it converts into a market order, meaning it will be executed immediately at the best available price. This price could be $47.90, or even lower, depending on market conditions and liquidity. A stop order guarantees execution, once triggered D, but not the execution price. It would only convert to a limit order if it were a stop limit order. Question 32. Which of the following would generally have the lowest expense ratio? A. Actively managed equity mutual fund. B. Index mutual fund. C. Hedge fund. D. Unit investment trust, UIT. Answer, B. Index mutual fund. Index mutual funds typically have the lowest expense ratios because they are passively managed. Their objective is simply to track a specific market index, requiring minimal research, trading, and management intervention. Actively managed mutual funds incur higher expenses due to portfolio manager salaries, research costs, and higher trading volumes. Hedge funds, being highly specialized and often employing complex strategies, have very high fees. UITs, while having a fixed portfolio and low ongoing management fees, may have high upfront sales charges. Expense ratios significantly impact long-term returns, making lower-cost options attractive. Question 33. What is the primary role of a designated market maker, DMM, on the NYSE? A. To provide investment advice to individual investors. B. To execute all buy and sell orders for a specific stock as an agent. C. To maintain a fair and orderly market for specific securities by acting as a buyer and seller of last resort. D. To underwrite new issues of securities for corporations. Answer: C. To maintain a fair and orderly market for specific securities by acting as a buyer and seller of last resort. A designated market maker, DMM, previously known as a specialist, on the NYSE has a crucial role in maintaining a fair and orderly market for the specific stocks they are assigned. They do this by standing ready to buy or sell for their own account when there is an imbalance of buy and sell orders, thus providing liquidity. While they also execute orders as agents, their primary responsibility is to act as a principal to stabilize prices and ensure continuous trading. This differs from the role of a typical broker or underwriter. Question 34. Which of the following is a characteristic of preferred stock? A. Voting rights proportional to the number of shares owned. B. Fixed dividend payments, which may be cumulative. C. Participation in excess earnings beyond the stated dividend rate. D. Priority over bonds in liquidation. Answer: B. Fixed dividend payments, which may be cumulative. Preferred stock is characterized by its fixed dividend payments, which are typically stated as a percentage of par value and must be paid before common stockholders receive any dividends. Many preferred stocks are also cumulative, meaning any skipped dividends must be paid to preferred shareholders before common shareholders can receive dividends. Preferred stockholders generally do not have voting rights, do not participate in excess earnings, and are subordinate to bondholders in liquidation. Understanding these features helps distinguish preferred stock from common stock and bonds. Question 35. A customer receives a Regulation T call in their margin account. What does this indicate? A. The customer's equity has fallen below the maintenance margin requirement. B. The customer needs to deposit additional funds to meet the initial margin requirement for a new purchase. C. The customer has purchased a security that is not marginable. D. The customer needs to liquidate securities to pay off a loan. Answer: B. The customer needs to deposit additional funds to meet the initial margin requirement for a new purchase. A Regulation T call, often simply called a margin call, specifically refers to a demand for funds to meet the initial margin requirement for a new purchase or short sale. Regulation T, set by the Federal Reserve Board, dictates the amount of credit a broker-dealer can extend to customers for purchasing securities. If a customer does not have enough cash or fully paid securities to cover their portion of a new transaction, they will receive a Reg T call, typically requiring them to deposit funds within 2 business days, S+2. This is distinct from a maintenance margin call, which occurs when equity falls below minimum levels after the initial purchase.